let's just dive right in. Today, we're cutting through the hype. You know, all that noise about AI making people overnight millionaires. We're moving past that. In this explainer, we're actually peeling back the onion to look at exactly how artificial intelligence is being used in the stock market right now. We're going to uncover the actual mechanics under the hood, the specialized tools you can use, and, crucially, the very real risks you need to understand before letting an algorithm anywhere near your hard-earned portfolio. To put things in perspective, I want to hit you with a pretty staggering number right out of the gate: 70%. AI-driven trading recently accounted for roughly 70% of all U.S. equity trading volume. Think about that. We are not talking about some fringe sci-fi future possibility here. This is the current reality of the market. The sheer scale of this revolution is massive, and it's actively shaping the prices you see on your screen every single day. Okay, so here's our roadmap for today. First, we'll look at the AI investing revolution, then prompting the stock market. After that, we'll dive into the AI app ecosystem, the hallucination hazard, and finally, ethics, bias, and regulation. Let's get to it. Part 1. The AI investing revolution. The engines driving modern markets. So a recent study pointed out that a whopping 85% of financial firms are already using AI. And this brilliantly illustrates what that complexity actually looks like under the hood. I mean, we're not talking about a basic chatbot here. It's like a giant puzzle of massive data pipelines. You've got natural language processing, or NLP, instantly scanning global financial news to gauge market sentiment in real time. Meanwhile, deep learning networks like LSTMs and random forests are crunching years of historical pricing data to assess risk and optimize portfolios. And all of this feeds straight into a high-speed execution engine. It's this incredibly sophisticated, constantly adapting web of analysis. Moving on to Part 2, Prompting the Stock Market. DIY prompt engineering for investors. Now, let's take this from Wall Street supercomputers down to your own laptop. It's fascinating how we can actually categorize our daily AI interactions. You don't just ask ChatGPT, hey, what stock should I buy? No, you use structured copy-paste frameworks to do the heavy lifting for you. For research, you can prompt an AI to break down a company's competitive moat, like its network effects or brand scale. Under strategy, you can literally feed it your age, risk tolerance, and capital, and ask it to build a classic Boglehead 3-fund portfolio or a dividend reinvestment plan. You can even use it for analysis and decisions, like prompting it to scan your portfolio for tax loss harvesting opportunities. It's really all about giving the AI a very specific job to do. So the crucial point here is this. When you're engineering these prompts, you really want to point the AI at researching great businesses rather than just trying to predict daily price action. As you know, fundamentals account for the vast majority of long-term returns. If you use AI to deeply analyze a company's free cash flow and profit margin trends, well, you're setting yourself up for success. Because at the end of the day, price follows the business. All right, Part 3, the AI app ecosystem. Picking the right tool for the job. But hey, what if you don't want to sit around engineering your own prompts? Well, let's neatly organize the chaos of this specialized app ecosystem. It really comes down to the specific job you're trying to do. If your focus is deep research, you've got platforms like Barebone AI, which gives you full-stack verified research right on your phone, or Fiscal.ai, which offers some of the deepest fundamental data histories out there for desktop users. Need a multi-brokerage conversational assistant to see your whole portfolio? Magnify fills that gap nicely. But maybe you're not looking for research, maybe you want actual trading signals. In that case, a tool like Danilfin provides transparent, explainable AI scores on a scale of 1 to 10. And if you're an active trader, you'd probably look at something like TrendSpider for automated technical analysis and charting. It's all about matching the tool exactly to your investing style. Part 4. The hallucination hazard. When algorithms confidently lie. Okay, up to this point, we've been talking about some incredible capabilities. But I want you to consider this rather terrifying metric: 40%. A recent university study found that general-purpose AI models have up to a 40% error rate on specific financial queries. Think about that for a second. Almost half the time, these models are confidently presenting completely fabricated data as absolute, undeniable fact. Let's look at how this actually plays out in the real world. Investors have asked AI for NVIDIA's current PE ratio, only to be handed a plausible-sounding but completely fake number. They've asked for Apple's recent revenue, and the AI just confidently gives them data from 2 years ago. And, my personal favorite, fabricating Wall Street analyst ratings for Tesla. Because, I mean, who needs real analysts when the algorithm can just invent a perfectly convincing price target out of thin air, right? But beyond the fake data, there is a massive psychological trap here: confirmation bias. Remember, these AI models are literally programmed to be helpful. So if you ask a leading question just to validate a terrible investment idea, it will eagerly compile a whole list of reasons why you're right, just to please you. Which brings us to part 5, ethics, bias, and regulation, the global guardrails. Now you might be wondering, when an AI makes a bad or biased trade, who exactly is liable? Let's move to the macro level to see how this builds out globally. World powers are racing to figure out how to regulate that massive 70% of AI trading volume we talked about at the start. It is a wildly complex and evolving frontier. If we compare the major regulatory frameworks right now, we can see two very distinct philosophies taking shape. On one side, you have China's centralized approach. They're taking a highly proactive stance, using national fintech development plans, enforcing data localization, and creating targeted regulatory sandboxes in cities like Shenzhen just to test AI under controlled conditions. On the flip side, the European Union is pursuing a path of strict, comprehensive oversight. They are leaning heavily into data protection through GDPR, building on existing rules like MiFID II, and most notably, they're classifying financial AI systems as high risk in their proposed AI Act. But, why does all this macro regulation matter to you, the everyday investor? Well, it matters because of the ethical tightrope we're all walking. We're dealing with black box algorithms. If you don't know why an AI is recommending a trade, you're essentially flying blind. And that is exactly why the push for explainable AI, fairness, and strict human oversight is so absolutely crucial. You literally have to understand the logic behind an AI's output before you risk a single dollar of your own money. Which leaves us with this final, critical question to ponder as we wrap up this explainer. As this technology continues to evolve, will AI truly democratize market access, giving everyday retail investors the power of a Wall Street institution? Or will it just build faster, more opaque, and more biased black boxes that leave us all guessing? AI is an incredible tool, for sure, but it's a double-edged sword. It demands your focus, your critical thinking, and your absolute oversight. Thanks for hanging out with me for this explainer. Keep learning, keep questioning, and I'll catch you